I really appreciate you coming over here. So hopefully, I'll be able to, give whatever information I have. I'm pretty sure a lot of you well-experienced people here. But just to kind of give my background, as Mahesh said, started as an engineer at Motorola. I was there for 10 years. Left Motorola and started a company called JP Mobile here in Dallas in '96. By 2000, the company has grown. We were one of the very, very early companies in the mobile space, mobile and wireless. I'm pretty sure you heard about first device we all were using as an organizer, Palm Pilot. So I was able to take the Palm Pilot and connect the Palm Pilot to a two-way pager, send, receive emails, that one. This was in '96 and '97. And believe it or not, like, so many people wanted that type of solution. We were able to sell our software and that cable together, $70 a piece on the internet, and close to 5,000 people just bought it just like that. And really the company has grown. By 2000 we raised close to $55 million, and the company is supposed to go public. The market crashed, we didn't go public. Then we merged the company with a company called Good Technology. And that company was acquired by Motorola within 6 months for $500 million. After that, was called by Microsoft to run their mobile and cloud incubation team. I was at Microsoft for close to 2 years. But as you know, I'm an entrepreneur. Once you start an entrepreneur, you want to again get back to. Left Microsoft and started investing in 2-3 different companies, exited 2 of them. But I felt like I'm kind of starting and stopping this stuff. That's where really the idea came about starting a fund focused on mainly technology and early stage investments, especially here in Dallas. Some of you know, like, we had a lot of good VC firms here, but unfortunately a lot of them kind of went down. 2 years back we felt it's a good time to start a fund in Dallas. So that's about a quick about my background and about the company. I will talk about that the company Good Technology later. So this is kind of give you what I'm pretty sure a lot of you already know, but I'm just kind of giving you how in the technology space, how when people are investing, if you look at, right, so if you look at what I call especially when you're trying to start a company. That's what I did. My first company, you go to your friend's family and beg, borrow, steal money, basically. Right, that's what you had to do in the beginning. Otherwise, really, nobody's gonna, look at your idea and all that. So that's what, if you look at most of the technology companies, they had to get friends and family. Then really nowadays, as you know, a lot of this crowdfunding also happening. A lot of companies, especially in the technology space, getting funded by crowd funds and angel funds. Then you kind of see right now slowly VC model also changing, because I'll talk about why VCs also start investing in seed funding. Before they never used to invest in the seed level, but now VCs are investing in seed funding. Then you kind of see once the company getting launched and all that, that's where really companies slowly start getting what I call a Series A funding from VCs. Then once kind of grows to the growth and maturity level, then when you had to invest in a few $1 million, only the VCs are really then IPO or banks can really finance the company. So this is a kind of quick really snapshot of where investments are happening, who is investing. Seeding, as you can see, definitely the valuation of the company is a lot lower. You definitely get anywhere, depending on again the company. Most of the VCs, if they invest at least $1 million, they try to get 30 to 35% of the company. So you have taken a pretty good chunk of the company. Even that's one thing really. As an individual investor, you are right. You cannot match the funds what the VCs are investing. You get diluted. Like for example, when we invest even really $100,000 here, we do make sure we do our pro rata every time whenever they are doing the next investments.
So you didn't invest again?
Oh yeah, we do even the next level of valuation. If you look at all these companies, once you kind of get to this level, at least really $6 to $7 million valuation of the company here. Mm-hmm. Once you get that level, hopefully some of them get to 40 or 50, depending on where they are, the revenue and all that.
So
right?
It's almost like investing in an oil well. You have to keep investing.
Yeah, so if you want to keep that percentage of your equity, you do want to invest. If you think that is the horse, you want to bet on it.
Okay.
You know, you don't want to bet on it, just kind of keep it whatever you have and get diluted. But that's what the difference between angel investing. I will talk about like a VC investing. As an angel investor, you will not be able to continue to invest the amount of money you need for your pro rata portion. You may get, and just to, you know, maybe in the beginning you must have got 4 or 5%. Yes, you're right, you get diluted even to 1% at the end by the time. But if the company has grown, if you've done well, when 1% of the, you know, $1 billion also good versus, you know, 100% of zero of the company. That's the way I kind of look at. Good, good question. So this is what I really, if you look at, right, this is the slide kind of where a question kind of ask, especially if you look at in the technology space, where do we really see company, you know, like a VC funds or in, you know, even you know, some investors have made money. If you look at in early stage, most of the money has been made in the companies when you used to invest in early stage. So when, you know, banks and all that, when they come, once the company going IPO and all that, or when the company about to sold, I'll talk about some of those examples. They also make money, you know, if they invested like a $50 million, sometime, you know, pretty quickly they make at least 2x. But the most of the early stage guys are the one, it's a high risk one, but at the same time that's where the most of the money will be made if you look at it. So it's interesting in Texas too. If you look at last, you know, it was not like this, but lately in Texas also it is changing. You know, in 2013 you can see 12 to 13 early stage investment has grown compared to what it used to be. So here again, you know, if you look at, you know, this is the slide, you know, what I said before, you know, early stage companies are the one, if you look at overall technology, amount of money being invested, and where you got 70% of the money actually gone back to early stage investors. Basically, you know, if the concept is there, you know, most of the time when they come to us, we tell them, you know, just go and work on the product. If you think it's a good concept, we may not invest, but we help them make sure like really you work on a product, at least prototype. Some of the investments we have done even at prototype stage, that, you know, we invested 100K, 200K, 300K at prototype stage, because one thing I'll talk about really later, you don't require that much money, especially I'm pretty sure you're in the software industry. Amount of money I raised in JP Mobile, $55 million. If somebody comes to me, they want to raise 55, I will never invest in that company, because you don't require that much money anymore, especially for software companies. I will talk about why when we get to the mobile cloud, why it's changing and all that. So we invest at least 200, 300 in that stage. Then sometime, most of the time really what's happening nowadays, most of these investors, they don't even really value the company at that time. They do what they call convertible note. You know, that can convert to a seed round. A seed round could be anywhere $2 million, you know, depending on the concept. Then after the seed round, you know, Series A, most of the time Series A is at least $5 to $6 million. So that time the product is done, they got maybe 1 or 2 customers been tested, and they're willing to, you know, use that product. So not generating revenue yet, what we call path to revenue. Once you get that one, then Series B, that's a growth. Basically that's the time like the company need to make sure like a salespeople you are hiring, or, you know, how you going to grow from the 2 or 3 customers to now scale. You know, that's where the Series B happens. Then Series C, as you know, like, you know, most of the companies lately in technology space, if you look at, they've been getting acquired by Series B or before Series C. So this is where really, you know, I just kind of coming to, you know, how you see, you know, this is not from me as a TechCrunch. I'm putting a source, you know, I put all this data together. It's not just from me, this is all industry data. Basically what's happening in the VC world, as you know, a lot of these, you know, funds have raised $1 billion, $500 million, especially if you look at most of the big funds. And what happened when the software industry changed, a lot of them, they could not even deploy that much money anymore. So if you look at this, where we kind of call a lot of this, you know, most of the VCs really, you know, would be investing in company, and then, you know, myself, I can talk about this stuff. In my company, I got one VC invested $25 million. You know, it's a good VC, but they would come to board meetings. You know, pretty much that's the board rate really. They will never involve much into the company, because most of them are good financial people, but they did not have my technology background, what I'm doing and all that. So then you have started in the Bay Area, especially a lot of the people like me who sold a company and joins a again a VC firm and start really coaching. You can see it's not only cash, but they're also giving a good brand, being a VC, and also some of the funding network, and they become a good coach for the CEO. A lot of them, they have done a pretty good job. If you really look at, Google was coached by Sriram, who the first investor who invested and made $3 billion from that company. So that's what happened. A lot of them are done very well. But what we noticed, the main reason really we started Naya Ventures, is not only really giving the coaching, but we felt you had to have the industry knowledge, and also you had to have your own network of people who can help the company. That's what we did, these two things, where we also have in-house expertise, help these companies in those areas. That's what we kind of, we actually first started, then now TechCrunch also using the same word, the new investment word is called portfolio operator model. This is a new industry term, is kind of evolving right now. We are the one actually started in the beginning. Now even TechCrunch also using it. So they're good to see, like really that's what evolved really right now. To answer your question, between everybody do different things, but that's what we chose to do because that's where our expertise are. And then I'll talk about, I did not put too many slides on our portfolio companies, but I can talk about like how we have done it, what we did so far and other. So if you look at so far, I wish I had my companies, I could have shown you stage. I didn't. I know last time I showed that one, but I don't have that one today here. But I think it does involve a lot more when you are doing at the seed stage. Sometimes they may not even have a team. We had to help them get the right team. Sometimes, most of the time really, if you look at, these are technology guys. A lot of them, they don't have any business expertise at all. So making sure like they have a good partner on the business side, he becomes a CTO, or then maybe he gets a partner as a CEO. That's where we help them a lot in the beginning with the people. Then also getting those 2 or 3, what is the validation, when you saw the first slide, how do you validate that concept? For example, one of the companies we invested, we were able to take them to Samsung and get the validation done right away. So that really gave us, not only us, but also other VCs were able to come in, invest within 3 months after we invested. They were able to come and invest. A company called Boxfish, that was our first investment. We invested $500,000. Within 3 months, T Ventures came and invested $3 million in the company. So that's one thing, you see like you had to invest a lot of time in the beginning, but once the company matures, and especially once you get a Series A, now that you're on Series B, we are helping them mainly. I was just telling her like hiring salespeople has been a big problem. That's one of the, not only sales, but especially in the Bay Area, hiring even technology people has become a big problem, especially in the big data and some of the areas we invest. Some of these kids coming out of college, are demanding close to $150,000, $180,000 salary, starting with. So that's one of the biggest problem right now, getting the talent for technology companies. So again, really, I'm sorry, this is where kind of a quick plug about Naya Ventures. How do we invest? We invest in a company only if we can help them. If somebody comes to us only, I don't need any of your help, you just need the money, we would not invest in the company. We make sure like, what the areas they require our help. Is it building the team, or is it to really, on the business development, or end of the day also, we will talk about like, because of our focused mobile cloud big data areas, what those areas, we can help within our ecosystem. That's been really very helpful for our portfolio companies, even for us also, because those connections we are able to use help them. So here, I think you were asking a question pretty much. This is where we look at like, do they have the concept is good, then also have the thought about, because even the money we are investing will not be enough for them. Even though we're going to put $500,000 or even $250,000 in the beginning, we're going to continue to invest up to $3 million. We invest anywhere $250,000 to $3 million in given one company. That's it. $3 million is max, but sometimes that money is not enough. But we also don't want to be only the guy to invest all $3 million, right? So we want to make sure like others, not just for the risk taking, but they also could help them in other areas where we could not help. So that's the reason we always kind of look at really, do we have a planned approach? I can tell you almost to 90% of our companies, we invested in 14 companies, all of them were able to get next level of funding after we invested. And 2 of them actually got even unsolicited offers last year, and both of them actually did not sell those companies, but now they went for Series B. You know, I'll talk, I didn't have the list, but I can talk about if you want to later. So then we want to really look at a clean exit plan. You know, this company, can we think of, because most of the companies, you know, if you look at 99% or more, they had to get acquired in technology space. They're not going public. Very few going to go public. So we look at, you know, which company could acquire this company. You know, we map that one right away. If we don't have, even if we don't think like we have a clear plan, we would not invest in that company. So then really, you know, the team, end of the day, as you know, when you're investing that early, you have to really make sure like the team is good, they are committed, and they have vested interest making this company successful. So far, you know, good really. Most of our 14 companies are still in business and they worked out pretty good. So again, as we talked about really, you know, can this company, some of them, you know, and I'm not talking about every one of the company, but can really become $1 billion company. That's what we, you know, this is a high risk kind of, you know, high reward game, as you can see. That's one of the things we look at, high growth areas. So again, as we talked about, like really, how do they leverage our connections within the technology space, within the ecosystem? You know, if they can, then the company qualifies for our investment. So we kind of lay out the plan, you know, in the beginning itself. You know, what does it take for him to get what I call, you know, going from seed funding to really next Series A, right? There's a huge gap. This is one of the things happening, what we noticed as angel invested companies, why they have so many failures. Because what happens, you know, a lot of angel investors, you get excited, friends and family, they put some money, but then for them to go to Series A, they do not have those VC connections and all that. The company cannot go to next stage. So that's what we call a gap between that friends and family to Series A. That's where we are able to help a lot of those companies, make sure like you know, they can get that funding from us, and not only the money, but what angel investors cannot do, also get them next level of funding and also their business development connections. That's where our value comes in. We do get from a lot of our investors, you know, fine, you guys right now, you know, maybe a few companies you are able to go and help them, but how can you help really once you get to level? That's the reason within this fund, we set up this fund as a $50 million fund, and we said any given time we will not have more than 22 companies. So hopefully we'll exit some companies, we'll invest in new companies. We have 3 partners, and not only our 3 partners, but what we did, most of our investors, you know, in the beginning, first I would say 10 million actually came from people like me who have started technology companies, sold technology companies. A lot of them also not only investors as LPs, but they also became advisors to the fund. So they've been very helpful in the areas they can help these companies. And you will see we focus only in 3 areas: mobile, cloud, big data. These are the growth areas, and these are the areas we happen to have also expertise in those areas. It's not just because the growth areas we're investing, but we happen to have connections. So we had to deal with, if you look at within the ecosystem, only 30-35 companies. I'm talking about mobile operators like Verizon, AT&T, and then device manufacturers like a Samsung, Nokia. Of course now Nokia is part of Microsoft, and then also software companies, what I call ISVs, Microsoft, SAP, Google, Apple, and all that. So we have a very, you know, focused niche, you know, industry basically, if you look at. That's the reason, and I hope I answered your question. We are able to do that one. For example, I'll tell you, like we were able to take, you know, I can talk about right now, one of our company, Glimpse, we were able to help them with Verizon. And we are also helping one of our other portfolio, 2 of other portfolio companies with Verizon too. So that's been a, you know, going back to the same people, and we don't go to only to the executives, but like what we call really people who are influencers, not only decision makers. That's where we started working with them. So that's been very successful for us. So after we invested in these companies, you know, last 2 companies, some of our investors, they were interested, hey, we also want to invest in these companies. So we created a kind of small, what they call sidecar fund, is only for that company. A company called Altia Systems, we invested $500,000. Then another $1 million came from our LPs. It's only for LPs. We don't take money from anybody else. only for our LPs. But good thing is, one of the LPs who invested $500,000, they actually sold a company to Cisco. So they have already this expertise. The company, the product we are developing, eventually, hopefully, be acquired by Cisco or Microsoft. So that's what we look for, how they can also add value. So if they can add value, we do take investments, and so we have done with one company. The other one, we're just doing really one of the companies we invested. We invested actually in the beginning Series A at 12 million valuation. And now the company actually gone to the now Series B. They are doing at 50 million valuation. So not only we are investing close to $1.5 million, but also we are allowing our LPs to invest up to $500,000. So we also kind of make sure, depending on the amount of money they invested, we allocate them. Somebody invested $500,000, gets different than $250,000. So we just started doing that one. Because of that, we felt it's good for the company, good for our LPs too.
But you do that more on a case-to-case
basis, exactly.
Versus doing that for
exactly, case-by-case basis. Like really, where we think really, especially we also kind of look at less risk, to be honest with you. Right now, at least once you get to Series B, we think the company is still a risk in the technology space, really, but a lot less risk than really in the early stage. So just kind of give you, and the VC funding terminology, these are all the things I'm kind of throwing all the names. Sorry about that. So basically, when you are investing early, that's what they call seed funding. I think that you understand, right? So after seed funding, most of these companies, what they call really next level of funding, just naming really. I think, but when you go ahead to go to next level of funding, what they call Series A, right? That is the one like where you have the product is done right now. Maybe you already have 2-3 customers. You kind of prove the product and all that. Then after the product is done and now you have proved, then you need to grow, right? That's the time you had to raise more money. So for that raise, again, that's called Series B. So it's go to Series B, Series C. Most of the companies, as I said, will be acquired or done something by Series at least C. In the olden days, they used to go to Series D, E, and all that. But nowadays, most of them get acquired by Series C. So it's interesting, right? I don't know how many of you know or not. Here, right next to Galleria, there's a building here on the 16th floor. We used to have pretty much all the big VCs in our, right? You're talking Hunt Ventures and Seven Rosen and Centerpoint. There were 6 or 7 VCs used to be in the same office space. They all used to share. They are done pretty well. I think the only thing what happened, I think, when Dallas and especially Texas, Dallas, I should say, we were doing very well in the, as telecom space. When we had a lot of companies started from people who are working at Nortel or working at Motorola or Ericsson, Alcatel. I know a lot of 2 or 3 my friends who started in 2000 sold those 2 of their companies to Cisco for $400 million. So those exits happened, but unfortunately when the telecom went down, that whole kind of investment also went down. So now we're kind of seeing a lot of, especially in Dallas, that day I was at this event, lot of family offices or like a small funds starting like us, but also now we are seeing some of the bigger funds also start investing in Dallas too, like especially Austin Ventures, and also there's one more fund started in Austin called Live Oak. It's a close to $200 million fund. There are other funds also starting here close to $200 million. So slowly we are building that ecosystem which we used to have actually kind of lost. So it's to answer your question, sir, it's kind of interesting how in the technology space, it's all depending on, are you investing in what I call on the consumer side, or are you investing on the business side, B2B side? When you say investing, I'm talking about the software companies we are investing. Are they focused on, for example, you must have heard about a company called WhatsApp. Yes. So it's a more consumer focused, right? We have done some consumer focus, but our focus has been mainly on the B2B side. It's a little less risk, but it takes a little longer because you had to get proven with the customer and all that. So for example, I told you like 2 of our companies, they after we invested within 1.5 years, actually both of them got offers to get acquired at a pretty good valuation. We could have sold it, but we did not. So I think I would say anyway after we invest, depending on anyway 2.5 years to 4 or 5 years, that's the timeline I would say. So this is what I'm trying to kind of give you, because we are taking investment from our investors. how I'm going to return the money. That's what I look at always, right? But same time, when we talk into these companies, when investing, first thing, be honest with you, what we focus on building the company, building a product, can really, somebody can use this product and you make sure like taking care of their customer. So as you say, like really, I can tell you some of these companies, they were able to get some deals done because once you say like at least company got funded by a VC, it makes a lot more comfortable for them. Yes, if this company is growing, they can also continue to get funded. But what's happening, right? If you look at, especially in the consumer space or some of the, technologies, even the B2B side, they know like innovation is happening outside the big companies. If you look at even really, Apple acquired 45 companies last year. A lot of us, nowadays don't even announce anymore. They just kind of only, they put a round number. Yeah, we acquired $200 million, for $200 million, 3 companies. They don't even mention names nowadays. So a lot of really what is happening right now, big companies, they have taken the research outside. When I say outside, like they are getting, basically the startup companies start, and once they get to a stage and they're acquiring companies. Actually at Cisco, they have a program. They ask some of their employees to go out and start a company. They invest. Once they get to a stage where the now product can be sold, they buy back the company. Recently,
they called outsourcing R&D
exactly.
instead of having the
exactly. So to answer your question, really, I think you had to make sure like a that's what if you look at one of the companies, I told you 2 companies, because they already got proven the technology. They had offers, but we did not sell it because we felt like there's a lot more. These companies definitely has a good team and can be grown. That's the reason we went to Series B right now. So I think all depending on really the company. And some companies, if you want to get to distribution, if you want to get support, for example, I'll give you, let's say somebody developed really, I don't know how much all of you understand the cloud. I've been hearing all these cloud names, right? There's the infrastructure as a service, platform as a service, software as a service. There are 3 different areas. But let's say somebody started really a product, to provide infrastructure as a service, right? So it's good like they may be differentiating with Microsoft or Amazon, but it's very hard for them to continue to stay in business. That technology, if we're offered by Microsoft or Amazon, it will be a lot more useful for that bigger company, because now you have what are you getting from Microsoft, but you're also getting the latest technology too. So I think as long as the companies, IT people, they do understand, like really some may have it, but most of the time they do understand these companies. Once they get to some stage, they will be acquired, or some of them will go public. For example, I'll give you like one of the companies we invested, JP Mobile, was acquired by Good Technology, but after 8 years now the company is going public for $1 billion valuation. But it's taken a long time, so it's all depending on really the company. So this is what really we invest. I'm sorry, maybe I should have put in the beginning itself, but really we focus mainly in the mobile cloud big data. I'm pretty sure a lot of you know what the mobile is, and all of you are using here. So if you look at really, it's amazing really, as I say, like my story when I started using this Palm Pilot, when I used to be in the airport and sending an email with a cable connected to my pager, people used to ask me, what are you doing? Now, and also I remember like we used to go to like Chase, any one of these banks. Hey, we want you to use mobile email. Most of the CIOs needs to ask me, can you give me an ROI? Why do you need to give mobile email for my employees? Can you imagine right now if you don't even give your employees mobile email, what they will tell you? So that's what really it had changed within the last 10 years, even last faster than what I expected, to be honest with you. If you look at right now, we kind of in the US, like we took a little time, but once we kind of got iPhone coming into the market, and is amazing, right? Even my wife also using right now, she does most of the email from her device right now. Before she couldn't even use it. That's what it had changed in mobile. Before, web also was fine, but like most stuff or transactions are done from mobile. That's the reason you can see like a amount of revenue, mobile app revenue as going to 58 billion in this year 2014. So this revenue, think about, is kind of created a new economy pretty much. The guy sitting in the garage, maybe writing his own apps, putting in the web on an Apple store, and he's making money, and also the guy got funded even $50 million too. So that's what really, if you look at it, a lot of credit goes to Steve Jobs here. What he has done with that, not only technology but business model. Be honest with you, when we started a company, even though we developed technology, but we didn't have that many partners to sell our technology. That's what Jobs has created, a lot of people to go and sell the stuff on the web. I think wherever you are in the world, pretty much. So the mobile space, we look at really mainly, this product can be a more of a platform. When I say platform, it's not only just an app which does maybe one task, but can it be used by other applications too? I'll give you an example. One of the companies we invested called a Glimpse, which really provides location based services. For example, I'm coming here right now, I can send a Sejal a glimpse, then Sejal can see exactly where I am right now, what speed I'm driving, how long it's going to take for me to get here. So that's the consumer side. So by the time we invested, they already had 1 million users worldwide. But we say like not only consumer, how this can apply to B2B side. So we went ahead and really talked to them and put a strategy together, how they can create these APIs. I'm pretty sure some of you know, some of you don't know what the API, application programming interface, which are used by software companies, where how other companies also can take your API and build technology around it. That's the way the Facebook got grown, that's the way Google has grown. Most of the software companies are grown by somebody selling your service through their product. That's the distribution really is happening right now, right? So because of that, Glimpse was able to give their API to BMW, Benz, GM, Ford. Every one of these cars are going with the Glimpse logo on their dashboard right now. Then they also are doing like think of how the technology can be used. If you order a pizza, you want to know where that guy is right now. So you will see Glimpse and that type of delivery model. Or really, let's say right now, you have called for your service, for your cable service. Most of the time they'll tell you, oh, somebody will be there 8 to 5. You don't know what time the guy is going to show up. But here with this technology, the guy can send you a glimpse within 15 minutes. Hopefully you can be at home. So that's what really, we look for really how this technology can be applied in multiple places. It could be B2C, which is to consumer, or B2B side. So that's what we look at companies to invest in the mobile. The cloud, pretty much really the cloud, when I say like it has been there, but only the name has changed. Before they used to be called application service providers, basically ASPs. But this technology also changed, and the cloud has grown like unbelievable right now. This is what I was talking about, platform as a service, software as a service, infrastructure as a service. So these are the 3 different areas within cloud, and each one of them is growing right now. So if you look at all the Amazon stuff, what Amazon is providing infrastructure as a service and also platform as a service. So we do invest in companies all those 3 areas right now. And I can talk about, if you want to details about those companies. But this is a pretty good growing area, and also we have pretty good connections. Then the big data. The big data is the one really I'm pretty sure you've been hearing. In the world right now, because of mobile and other stuff, there's so much data companies are collecting, but they would like to really act on the data. Once you collect so much data, what do you do with the data? So we also investing in the companies in this area. They're doing pretty well. So this is kind of give you really, I'll kind of go through quickly here, but how the smartphones are growing. 80% of really US people are going to have smartphones pretty much. Right now, if you look at, we are the highest in the world, but it is also happening in other countries too, India and other places, because even smartphone, iOS or Android devices prices are going down. India, you already have 850 million users, mobile users, and think about even half going for smartphones, what that could be. For them, they did not have really regular wireline connection. The wireless and mobile device is their computing device. Think about how many things they are doing already, how much they could do from the mobile device. So this is kind of talks about again really giving a data about really what's happening with the amount of data you are collecting. You had to analyze a lot of this data. I'll give you an example. One of the company we invested, a company called Minetta Brook, based in New York and Seattle. They have developed technology. I don't know how many of you here hedge fund managers are really financial people, but they're focusing right now first in the finance stuff. Basically what it does, let's say right now one of the hedge fund managers is looking to buy Samsung stock. He puts a notification on Samsung stock. This technology, which has natural language processing and also artificial intelligence built into it, it can come and tell you about a news happened in Japan about a factory closing, but that even news never mentioned about Samsung at all. But it's able to find out actually that factory was supplying chipsets to Samsung. If those chipsets get delayed, you will not be able to deliver, Samsung will not be able to deliver their devices on time. It will show him, by the way, you are buying the stock, but here is the information, this stock can affect you because Samsung will not be able to deliver those devices. That's what the big data intelligence is all about. Basically what we call, it is taking a lot of news and also a lot of all the data before we never used to care about, taking all this data, analyzing the data and giving back something useful for the user. That's what's happening in the big data. So again, this is the cloud I talked about, like I don't need to go through, but how it is growing. All of you have been using right now cloud, whenever you're using even Facebook, whenever you're using like a Google, all of them are in the cloud. If you can see, like every one of the companies, pretty much now what we are seeing, even the big companies also started going from what they call their in-house cloud to public and private clouds too. So that's a big shift is happening. If you look at how the technology is changing, like we had this server client server model now, where you buy a lot of hardware and all that. That's what the reason I was saying, when you invest in a software company, you can start right now with less than $100,000. You can get from Amazon a server for $200 leasing. Before you had to buy maybe for $4,000. So that's what really changed. Amount of money required to invest in a software company has gone down. It's good and bad. A lot of people can invest now, amount of money required. But same time, really, it's not only that early investment, but how do you take it to the next level? I think that's where really we feel like we're making a difference. So this is kind of really give you a quick really kind of what happened within this space right now, especially mobile cloud big data. A lot of you must have heard about the WhatsApp and Instagram. This is the company, the Israel-based company, was acquired by Google for $1.3 billion. You asked a question like, they were able to take the technology, integrate into Google Maps. That's the reason right now when you're using Google Maps, it will also tell you where the traffic is, congested and all that, because of that data they are collecting. It's all data. Everybody wants data. So if you look at a lot of these companies right now, one of the areas also we've been investing what the cloud security and the data security areas. I'll talk about. For example, one of the companies we're looking at right now, I can't talk about it, details, company name, but they actually able to come up with some technology where, most of the time, as you had to enter these keys and all that, right? For your access the network and all that. These guys are able to come up with stuff even with your mobile device. You can pretty much identify who you are, and it will be able to scan and see like you are the right person or not. I'm just kind of giving you some. Then one more company we are looking at. What's happening with the cloud? For example, Dropbox. You share a file. You don't know what that person, where else he is sharing with. His file is going on. But this company has developed technology. Whenever you are sharing a file, you have a control how long that file can be viewed, how long it can stay on their laptop, or where they forward that file to also, you will get to know. So you'll have the complete trail of like where the file went to. So that's the kind of security technology we are looking at. And so it is a, especially as I'm pretty sure you've been hearing about a lot of this now between China and us. A lot of this stuff is happening because this whole cyber security and you must have heard about yesterday, I think day before yesterday, Chinese announced they want to kick all our consulting companies out, McKinsey's and all that, because they're kind of threatening, you are gonna sue some of our people, we're gonna kick all these people out. So it's definitely a problem, but we continue to build technologies, but people hackers continue to find ways to get in. So this is one of the, I'm happy to tell you, this is the company we invested, JP Mobile. Now they're going public. I'm happy to see some of my employees going to do very well. They're still working there. And so this is again Splunk. It's also a big data company, and I'm pretty sure you heard about Dropbox. Raised $250 million at $10 billion valuation. Again, this is also a cloud company. You can see Snapchat, which is again it's a chatting. They have raised $60 million. And one of our company I just kind of mentioned, like really, Glimpse has raised close to $15 million, and really Now actually it's more than 10 million users using every day all over the world. So it's kind of key really, when you are investing, the best practices what we kind of look for really. And as I say, like build a platform, that's what we tell entrepreneurs, and prove your platform with your own first app. When I say like really, that's what Glimpse did. They were able to prove their platform, developing that application where a consumer can use it. Partnerships, this is the key for any startup company. You cannot hire enough salespeople to go and sell your product. You had to have partners promoting and selling your product. Again, the talent, always look for a talent which is complementary to you. Just because the person agrees with you, don't hire them, but how they can complement with you. And also the business 101 really is in the especially technology space, what we call fail fast. Really, if it's something the business model is not working, I'm pretty sure you heard about a new word called pivot. That has become a really, but that's what a lot of companies have seen it, like really, how quickly the companies who pivot and as long as they can, succeed in that new model, they have done very well. But some companies who stuck to their own old model, they fail. To answer first, like really, you're exactly right. The cell coverage has been a big problem. I'm pretty sure you heard about this is what they call local cells. The apartments also can install and provide as a service too, depending on the again, there are companies came with that business model too, and some even AT&T also providing, but only thing you had to call them. You had to call them, hey, I don't have good service. They'll come and install what they call this local cell, which can connect to the device will connect to that one, then that will connect to the outside. So to answer your question, yes, actually one of the companies, again, we invest in those hardware companies which are building not only the hardware, but also they are building what we call cloud-based service. For example, one of the companies last time Mahesh and Sejal saw, a company called Altia Systems we invested, they developed a camera which actually, two Stanford guys, they developed where you have 6 cameras on one small device like this. It can give you 200-degree view for any room where you can install. But not only the giving the cameras, but it can stitch all those 6 cameras and give you like really as a one screen. So this company not only developed this hardware, but they also developed the software. You can stream all that into the cloud. Then you can join the meeting right now. You feel like you're sitting right next to the room. I'm pretty sure some of you already have or seen what they call telepresence Cisco developed. Telepresence would cost you anywhere $30,000 to $40,000 to install, but this is less than $600. You can buy that hardware and install in a room. Now you're able to join that one. So we did invest in a hardware and software combination company. Our fund, as I said, like it's a $50 million fund we set up as. So what we did, as I said, in the beginning we knew, we will not be able to go to what they call fund of funds. There are funds, they invest in venture funds, or really, as you know, a lot of LPs are like a pension funds and all that. We did not go to them first. We said we're going to really first to raise capital from individuals who could really understand what we are doing and all that. So that's what we did, first $10 million. So we have said $250,000 as a minimum for an individual, as a company $1 million to invest. And now we have been talking to some of the family offices and also some of the fund of funds. Some of them already now committing $5 to $10 million to invest in the fund. So our goal is to close within the next 6 months. We are getting close to right now $20 million already, and are close to rest of the $30 million within the next few months, pretty much. The way the fund structure we have put in, what they call 2 and 20, it is a 2% management fee, and the 20% is the carry. The carry is really to explain what the carry is. Basically, these are the 20% of the proceeds from your profits goes to GP, the 80% goes to the LP, the investors. So first we had to return. Let's say right now somebody has invested $1 million. We had returned that $1 million. We also put a hurdle, preferred return. That's what you can call 8% preferred return. So until we return that 8%, we can't take any profits at all. Let's say really we invested, somebody invested $1 million, and this $1 million invested in 2 different companies. If you sold one company, let's say for our $500,000, we got $2 million. Out of those $2 million, we had to return that $1 million first. Then we also had to return interest, that 8% interest. If let's say it's only after 1 year, hopefully we sold, and $80,000. It's $1,080,000. Then whatever left, $920,000, that will be split 80-20 between the 80% goes to the LP, 20% goes to the GP.